Greetings investors, and happy to announce that cPROFIT has completed 11 years, and thank you so much for your overwhelming patronage. And let's move ahead with the monthly market outlook for August 2024. And these are all some kind of inputs in a nutshell. Maybe in the global markets, if you look at India outperforms, right? And then actually just even among the Morgan Stanley Composite Index, probably with the India's bond inclusion also it outperforms. And again actually just Nifty mid-caps performance is one among the tallest, is what everybody knows. In July actually just among all the caps, mid-caps stood number one. And not only in India, across the globe, maybe just if you look at NASDAQ, last 10-year performance vis-a-vis Nifty mid-cap, we are almost closer to that one. And rupee remaining stable is one very big plus for India undoubtedly. And coming back to the domestic markets, mid-cap, as I said, outperformance, and technology and just healthcare were among the very topmost gainers in the month of July. And banks also just banks were bit laggards in the month of July. And one biggest news is about 78% of Nifty, which comprises of 50 stocks, have just performed very well. And again actually out of BSE 200 stocks, 76%, maybe closer to 133 stocks have just performed exceptionally well in July, which shows that it is a broad-based rally. And again, revenue and profit growth are likely to just converge in the financial year 2025. And you look at the flows and volumes, maybe just we used to say that we always depend on the foreign portfolio investor to the biggest change. Maybe just there is an important slide called domestic owners vis-a-vis the foreign portfolio owners, and we are ahead of foreign portfolio investors today. Flows and volumes, as I said just right, domestic inflows have been on the upswing since 7 months, and it exceeded the entire calendar year 23 flows by 40%. And then monthly average cash and F&O volumes also remains very robust. And again, just coming back to the thing, there was a very important thing that has happened. There is a Union Budget 2024 was announced by the fag end of July. So as such, actually just a lot of changes have been announced. We are planning to take the budget and the taxation changes in a separate episode as well. And but right now, let's try to cover a bit. And multi-year highs and lows. Forex reserves is at all-time high. We have touched $671 billion, which is a very welcoming kind of a sign, and which a thumbs up is being given across. And India's market capitalization to GDP is at all-time high. Coming back to valuation, as we have been keep on stressing this point, is we are a bit expensive market, and the 12-month trailing PE for the Nifty stood at 23.9. That is at a 6% premium to its previous peaks, say like 22.5 is the previous peak. And again, India outperformance key global markets, not only on the month-on-month basis. The first half is talking about the month-on-month of India vis-a-vis the world indices, and we are in the top rank. And again actually calendar year 24, that is year till date performance of global indices vis-a-vis India in terms of just USD. Again we are the topper, we are number 3 there post S&P 500 Taiwan. And Morgan Stanley Composite Index, and just in the MSCI indices, and we just outperform, and China has been a laggard. Maybe just go look at the purple line which talks about India, we are on the top, and then the red line which talks about China. And again actually just this is something I told earlier, which is quite interesting. You go to the decadal performance of NASDAQ vis-a-vis mid-cap performance in India. So maybe the black one is talking about NASDAQ with 403, a decadal kind of a thing, vis-a-vis just India mid-cap, which is almost closer. And INR remains stable, which we just told earlier. And again actually just you look at the stability in the INR, which is being marked in the blue line vis-a-vis the global countries. And this was just told earlier, just closer to just around 41 stocks out of 50 stocks in Nifty has performed pretty well in July. And again actually just 133 of BSE 200 outperformed, which says that it is a by and large is a broad-based rally. And again, retail participation continues to scale up, which is quite interesting, because there was an article which I often get reminded of, which just came in a Tamil magazine in 2008 as to who saves India. and the conclusion used to be Indians save India. The similar thing continues even post several years, right? Post 16 years also we talk the same thing. See, just look at the demat accounts that's been opened in India, which has gone 4 multiples in 4.3 years. Right now we stand at 162 million. And again, you look at the monthly SIP flows, and which has been crossing 213 billion, which is a welcoming sign. And of course, Indians are going to save India. Forex reserves, we spoke earlier, $671 billion is phenomenal. And these are some of the key taxation changes. As I said earlier, we are going to take it in a separate episode. Again, actually, this will come back to this slide, as a lot of things are to be watched in this particular slide. And market gap to GDP is at all-time high. We are at 142% right now in terms of market cap to GDP, and a long-term average has been 85, which says that we are slightly expensive undoubtedly. Again, just go back to the crisis period. How was we in the financial year 2020? We were at 57, and today we are hovering at 142%. And nothing would be, a market update would never be complete without talking about US economy. And US is like running at a $35 trillion debt, and maybe just, which is a very big concern undoubtedly. And S&P 500 is expensive vis-a-vis the historic levels. You look at the forward PE, which is hovering at 20.69 vis-a-vis the history. You just go to the historic levels, which is at 16.73. That is the 30-year average. So that means that even US markets are relatively expensive. And coming back to Indian economy, which is always like a oasis in the desert, right? So IMF, Indian Monetary Fund, raised our projection, our financial year 25 growth forecast to 7%, which is phenomenal. And actually our trade deficit is narrowing down to $20.98 billion. And again, actually we added more than 4.7 crore jobs. You remember earlier, just in the previous episodes, we spoke about this concern, and which is getting addressed now. And the CPI inflation, see, right now we are just hovering around 3.42%, and slightly just have slowed down. That is slightly the inflation has come down, which is a welcoming sign. And then actually just maybe just we have also just started maybe just buying from Russia, as you know, at a discounted price, right? We are also able to peg it to INR. So thereby actually we have saved more than $10.5 billion. And GSEC demand, government security demand, is likely to go up, because close to 4 to 5 lakh crores may come to the Indian government securities, as maybe just government is talking about a liquidity coverage ratio revisions in the coming days. GST collection is the near normal, has been $1.6 trillion, which is very, very welcoming, as you know. And India has been spending more than 6.5% of the GDP to infrastructure. And one more interesting data point is, say, like even you talk about the overall investment to GDP ratio, where investment to GDP is just hovering around 35.5%, which is really brilliant, right? So India tops among the emerging markets as well. Say, just like we are on the top in terms of composite index score, as well as in terms of GDP is a real great number of 7.8. And look at the manufacturing index and rest all, we are doing exceptionally well. Having said that, how about the valuations? I said just even we have been, we keep insisting that we are sailing at a premium to historical averages, and large cap is sailing at 14% to premium, 14% premium to historic average, mid cap 50% premium to historic average. That's what we said just July month, mid caps were the top, and we are even, our Indian mid cap is trying to beat the decadal performance of Nasdaq, I said. Small cap is running at 40% premium to historical average. I think that you can read between lines, because when something is expensive, it is big time for you to just book the profits depending on the kind of goals that you have. If you have any near-term goals, then it is time has just come for you to book profit in some of the caps. And this is APIs have turned out to be buyers in India, and apart from DIIs. And this is something which everybody has to remember. Anyway, taxation ways also it's better. Not taxation ways, I'm sorry. Maybe just better to just invest in duration. And because if the interest rate cut happens, these bond funds will rally at a premium, right? So good to just procure the long term or duration bonds. Capital markets see a rise in share of household flows. As I told you earlier, just see, right, we just gone up in a brilliant way in terms of demat account openings. I said just around 143 billion is what I said, and then again actually just 143 million, I'm sorry, and then again decadal distribution of flows into financial assets. You look at this numbers, 37% is just going to the bank FDs, and vis-a-vis just 20% which goes to the PPF kind of a traditional way of investments, and only around 7% goes to mutual funds, shares and debentures, which says there is a long way to go for the capital markets in India. And IMF projects steady global growth rate in 2024. If you just read the numbers rightly, say like 2024, the projection is 3.2%. Earlier, you go to the previous slides, previous episodes, we spoke about 3% growth rate across the globe. It has gone up slightly with IMF projection, and by FY 2025 or calendar year 2025, you can see the projection is around 3.3, which is a brilliant thing. And again, what all the risks that we carry is what everybody used to ask, right? When the markets are high, good to stay put, exit. See, just it all depends on your risk profile, your investment horizon, and the kind of goals that you have, right? So what all the risk of in the current market? US recession. Yeah, we spoke about the unemployment issues there. We spoke about the real estate issues in the previous episodes. And then, yeah, is it likely to get into a soft landing? That's what everybody projects. And Israel vis-a-vis Iran conflict, yes, it is a matter of concern. Unwinding of yen carry trade, there is another concern, because Japan actually just recently just revised the rate downwards. So that is a concern, and China slowing down, and Bangladesh crisis. All these are some of the things. And these are some of the inputs we thought of sharing with you. And before I just wind up, I want you to just to be part of this particular slide with me, and about the key taxation changes in the Union Budget 2024. As I said, we'll take it up separately as well. Stocks, actually just earlier the short-term capital gain period used to be 12 months, even now the same thing. And instead of 15%, it is getting revised post July 23rd, 24 to 20%, right? And then the long-term capital gain on equities or stocks used to be just around 10%, that is getting revised upwards to 12.5%. And again, be it on the equity or on the equity mutual fund, there is an exemption limit. Up to a lakh of long-term capital gain was exempted. Now actually just it has gone up to 1.25 lakhs. Coming back to debt and non-equity mutual funds or funds that invest in less than 65% in equity, it is as per the tax slab. Bonds, we are talking about the listed bonds, and listed bonds actually just again there are traders who buys and just sells it, right? For them actually just there is a short-term capital gain at the rate of 20%. There is no change in the holding period as such. It is 12 months even earlier and now, and beyond actually just the 12 months, it has just gone to 12.5%. Earlier it was 10%. Real estate investment trust or infrastructure investment trust, you look at the thing, short-term capital gain is taxed at the rate of 20%, and it is 12 months. The holding period is 12 months. Earlier it was 36 months. And then the long-term capital gain is 12.5%. It has gone up there. And equity fund of fund, right? So it used to be just the short-term capital gain is 20%, and then actually just the long-term is 12.5%. Earlier, if you remember, it was like a bond fund. And gold or silver ETF and short-term capital gain is 20%. And 12 months is the period. Earlier it was that is, and again actually just beyond 12 months is in the ETF, gold ETF and silver ETF, it used to be just called as a long-term capital gain, which is getting taxed at 12.5%. And gold funds, again actually just 12 months is the thing. It says slab rate, and then more than 1 year, 12.5%. Again, just come to the real estate physical. There is a bigger revision there. Maybe just we have to take it as a separate episode for that. And physical gold, as per the tax slab, if it is less than 2 years, and then actually just earlier it used to be 3 years, now it is 2 years, and then 20%. Earlier more than 2 years, say like earlier more than 3 years it used to be 20%. Now that gets revised downwards to 12.5%. So gold is going to shine. And foreign equities, again actually is a slab rate, more than 2 years. It is going to be 12.5%. So this is what we thought of just letting you know others are. And thank you so much for joining us. And then a lot more inputs to share. We'll take it in a separate slide. The information provided here is true and best to our knowledge, and solely prepared to just bring in some kind of awareness to the investors about the markets. And pardon me in case of if I'm just fast, because my team wants me to limit the timing. And then the views expressed here are just garnered from different kind of sources, and please just contact your advisor if you want to just work on the asset allocation, and always take effective decisions based on your risk profile, goals, and etc. Thank you so much for joining, and